This is a weekly podcast of your average Indian investor. Today, we're taking a close look at something called Flexi Cap mutual funds. Sometimes you're thinking, should I put money in big companies? Or maybe those medium-sized ones? Or what about the really small, fast growers? Well, Flexi Cap funds, they sort of try to give you the best of all worlds.
That's a good way to put it. They basically let the fund manager decide where the best opportunities are, whether it's large, mid, or small companies.
So they can, shift the money around based on performance and potential returns.
Exactly. The key word here is flexibility. The manager isn't locked into fixed proportions for different company sizes.
Right. If they think large companies are the place to be, they can go heavy there.
Or if small caps look promising, they can pivot towards them. It's all about adapting to the market.
Okay, makes sense. This adaptability sounds like it could be really useful.
It can be. It potentially leads to a well-diversified portfolio, which is often what you want for long-term goals.
So today we're going to really unpack these Flexi Cap funds, understand what they are, how they work, and maybe look at some of the funds that have done well consistently.
Sounds like a plan. Let's start with the basics then. What exactly is a Flexi Cap fund?
Okay, so at its core, it's an equity fund, meaning it mainly invests in shares of companies. The rule is at least 65% of the money has to be in equities.
Right. And the Flexi part comes from where those equities are. They can invest across large cap, mid cap, and small cap companies.
And crucially, in any proportion they choose.
Precisely. There's no mandate saying, you must have X% in mid caps or anything like that.
So the remaining 35%, what about that?
Well, the fund manager has discretion there too. It could be in other equities, maybe some debt instruments, or even held as cash for opportunities.
I like the analogy you used earlier, like a cricketer who can bat anywhere in the order depending on the match situation.
Yeah, it's kind of like that. The manager adapts the portfolio strategy based on the market pitch, you could say. If large caps look defensive and stable, they might increase exposure there.
And if they see a rally coming in smaller companies, they have the freedom to jump on that.
Exactly. And this ability to invest across the spectrum, across different size companies and often different sectors, provides diversification.
Which in theory should help manage risk over the long run.
That's the idea. By not putting all your eggs in one market cap basket.
So who should be looking at these funds then? Are they for everyone?
Generally speaking, they're more suited for investors with a longer time horizon. Think financial goals that are at least 7 years away.
Because that gives the fund manager time to navigate market cycles with that flexibility.
Pretty much. If you want diversified equity investments and you're patient, they could be a good fit.
Okay. Now, there are quite a few Flexi Cap funds out there. How do you even start figuring out which ones are, the better performers? It can't just be last year's return, right?
Absolutely not. Short-term performance can be misleading. What you really want to look for is consistency of returns over the long term, and importantly, how much risk the fund took to achieve those returns.
Consistency and risk. Okay. How do we measure that consistency part?
A very useful tool is looking at rolling returns, typically over a fairly long period, like 7 years.
Rolling returns. How does that work? In simple terms.
Imagine you have, say, 10 years of performance data. Instead of just one average return for the whole 10 years, you calculate the average return for every single possible 7-year period within those 10 years.
Ah, okay, like years 1 to 7, then years 2 to 8, years 3 to 9, and so on.
Exactly. It gives you a much smoother, more reliable picture of how consistently the fund has performed over time through different market phases. It's a bit like looking at a daily SIP average over many years.
That makes a lot more sense than just a single number. So I assume funds that haven't been around for 7 years wouldn't be included in this kind of analysis.
Correct. You need that track record for this methodology. So if you started with, say, 38 funds, you might end up with only about half that have the required history.
Right. So using these 7-year rolling returns, what was the next step in identifying the stronger funds?
The first filter was simple. Only consider funds whose 7-year rolling return was higher than the average return for the entire Flexi Cap category.
Okay, so beating the average consistently. What about the risk part?
That's where standard deviation comes in, specifically the 7-year rolling standard deviation.
Standard deviation,
Yeah.
That tells you how much the returns jump around the average, right? Volatility.
Precisely. A lower standard deviation generally means a smoother ride, less volatility. So the second filter was to look for funds with a 7-year rolling standard deviation that was lower than the category average.
Got it. So the goal was to find funds that delivered higher than average returns, consistently, but with lower than average volatility.
That's the sweet spot, yes. higher returns with less drama, essentially.
Yeah.
This process helps narrow down the list significantly.
Okay, that sounds like a solid approach. So which funds actually made the cut based on this? Can you talk about some of them?
Sure. Let's discuss a few key ones that emerge from this kind of analysis. We won't rank them strictly, but maybe look at them based on their size, starting with the biggest.
Sounds good. Who's the largest player in this Flexi Cap space?
That would be the Parag Parikh FlexiCap Fund. It's quite large, managing assets over 84,000 crore.
Wow, that's a huge amount. And how did it fare on the rolling return metric?
Its 7-year rolling return came in at around 17.95%. Quite strong.
Can you give us an idea of what that means in terms of actual growth for an investor? Maybe an example?
Sure. Let's say you invested 1 lakh about 5 years ago. Based on its performance, that could have grown to roughly 3.21 lakh.
Okay, that's significant growth. What about someone investing regularly, like an SIP?
Right. If you'd done a 10,000 monthly SIP for the last 7 years, so you would have invested a total of 8.4 lakh. That could potentially have grown to about 19.87 lakh.
Impressive numbers. Who's managing this fund? What's their approach?
It's managed by Rajiv Thakur. He's known for a value investing philosophy, sort of influenced by greats like Warren Buffett. They look for solid companies, often with low debt, good returns on equity, maybe paying dividends. And an interesting aspect is their allocation to foreign stocks, mainly U.S. companies, for diversification.
Ah, the global diversification element. That's quite unique. Okay, who else stands out?
Another major fund is the CK Flexi Cap Fund. It's the third largest, I believe, with assets over 51,000 crore.
And its performance.
The 7-year rolling return was around 14.96%.
How would our 1 lakh investment example look here over 5 years?
That 1 lakh could have grown to approximately 2.29 lakh in 5 years.
And the 10,000 SIP over 7 years?
The total corpus from that 8.4 lakh investment could have been around 16.35 lakh.
Still very decent returns. And the fund manager?
This one's managed by Harsha Upati, who's a real veteran in the industry.
Okay, moving on. Any others that pass the consistency and lower volatility tests?
Yes, the DSP FlexiCap Fund is another one. Its assets are around 11,765 crore.
And the 7-year rolling return?
That was about 13.73%.
Growth examples for DSP?
A 1 lakh investment 5 years back might have grown about 2.5 times. And the 7-year, 10,000 monthly SEP could have resulted in a corpus of roughly 17.55 lakh.
Now, I think I heard something about a change there recently.
Yes, that's a key point. DSP FlexiCap had a fund manager change back in March this year. So while the past performance is based on the previous manager, investors would need to consider this change.
Right, definitely something to keep in mind. Who else is on the list?
There's the PGM India FlexiCap Fund. AUM is around 6,300 crore.
Performance?
7-year rolling return was roughly 14.74%.
And growth, say the 1 lakh lump sum over 5 years.
That could have grown to about 2.85 lakh.
In the 7-year SIP.
The 10,000 monthly SIP, totaling 8.4 lakh investment, might have grown to around 1.64 lakh corpus. It seems there's a typo in the source material for this SIP example. The return should be significantly higher given the lump sum growth and rolling return. Let's assume the SIP example intended to show substantial growth, perhaps closer to the DSP fund's SIP result, given similar rolling returns. Let's say it resulted in a corpus closer to 16.4 lakh, not euro 0.64 lakh.
Okay, assuming a typo there, and it also showed good growth. Good catch. And the last one to highlight.
The Edelweiss FlexiCap Fund, smaller in size, around 2,446 crore AUM.
Rolling return.
About 14.34% over 7 years.
And the growth figures.
The 1 lakh investment 5 years ago could have become around 2.8 lakh, and the 7-year SIP of 10,000 per month. The source notes a gigantic percentage increase, 18.94% annualized SIP return, suggesting the final corpus from the 8.4 lakh investment would also be quite significant, likely well over 18 lakh.
Okay, so several funds showing good long-term risk-adjusted performance. Now, you mentioned FlexiCaps offer flexibility. How does that compare to, say, multi-cap funds? Aren't they similar?
That's a really common question. They sound similar, but there's a crucial difference in the rules. Multi-cap funds also invest across large, mid, and small caps. But they have a strict rule. They must invest a minimum of 25% of their assets in each category, 25% in large, 25% in mid, and 25% in small at all times.
Ah, okay, so they have to maintain those exposures even if the fund manager thinks maybe small caps are going to underperform for a while.
Exactly. That 25% minimum can become a constraint. They might be forced to hold investments in a segment they're not currently bullish on. FlexiCaps have no minimum allocation requirements across market caps. The manager truly has the flexibility to invest, say, 70% in large caps and only 10% in small caps, if that's their view, or any other combination.
So much more freedom to adapt the portfolio based purely on market outlook.
Precisely. And that freedom is probably a big reason why flexi-cap funds have seen, really strong inflows from investors lately compared to many other equity categories. People seem to value that adaptability.
Makes sense. More room for the manager to potentially add value. Now, I also saw an interesting head-to-head comparison between two specific flexi-cap funds, Parag Parikh and HDFC. Can we dig into that a bit?
Yes, that comparison highlights how, even within the same category, funds can have different approaches. Both Parag Parikh and HDFC FlexiCap have generally outperformed their benchmarks and the category average over various time frames.
So both are strong performers. What are their basic goals?
Pretty similar on the surface, aiming for long-term capital growth by investing in equities. The big strategic difference, as we touched on earlier, is Parag Parikh's inclusion of foreign stocks.
Right, the international diversification. HDFC sticks to India only.
Yes, HDFC FlexiCap is purely domestic.
And the people running the show.
We mentioned Rajiv Thakur for Parag Parikh, focusing on value and long-term picks, along with Rukun Tarachandani handling the overseas part. For HDFC FlexiCap, it's Roshni Jain, another experienced manager known for stock selection.
Performance-wise, any significant difference between them?
Both have done well. Some analysis, like value research rankings, might show Parag Parikh having a slight edge in longer-term consistency, but both are generally well-rated. It's more about how they achieve the returns.
Okay, let's talk about that. How do their portfolios and investment styles differ?
Parag Parikh often holds more in banks, finance, and software. HDFC also likes banks, but might have more in autos and pharma. Parag Parikh tends to hold more individual stocks, but interestingly, both funds are quite concentrated in their top 10 holdings, meaning a large chunk of assets is in just a few companies.
What about how often they buy and sell?
Parag Parikh generally has a lower portfolio turnover ratio. They tend to buy and hold for longer periods.
And the type of companies?
Yeah.
Large, mid, small.
Parag Parikh leans more towards large caps. HDFC has a more noticeable allocation, maybe around 12–13%, to small caps, which could add a bit more volatility, potentially.
And the investment style? Value, growth.
Parag Parikh is often described as following a growth style, looking for companies with strong potential. HDFC is typically categorized as GARP growth, at a reasonable price. So they want growth, but they're also very conscious of the price they pay for it. Oh, and Parag Parikh also tends to hold higher levels of cash sometimes, waiting for the right opportunities.
So different sector focuses, different turnover, different market cap exposure, slightly different styles. Quite a few distinctions. What about risk?
This is interesting. When you look at risk-adjusted returns like the Sharpe ratio or Sortino ratio, which measure return relative to risk taken, HDFC FlexiCap actually tends to score a bit better.
Meaning it delivered good returns for the amount of risk involved, especially downside risk.
Yes, that's what those ratios suggest.
How do they behave in different markets, like bull versus bear markets?
HDFC tends to have a higher upside capture ratio, meaning when the market rallies strongly, it tends to capture more of those gains.
But the flip side.
Parag Parikh tends to have a better downside capture ratio. It generally holds up better, falls less when the market is going down. So potentially more stable during corrections. Overlap between their portfolios is relatively low. Maybe only about a third of the stocks are the same.
So holding both could actually provide decent diversification within the FlexiCap space itself?
Yes, because you're getting exposure to slightly different styles, sector bets, and that domestic versus global tilt.
All right, this has been really insightful. So wrapping things up, what's the main takeaway about FlexiCap funds?
I think the biggest thing is that freedom and flexibility for the fund manager.
And for investors considering them.
Funds like the ones we discussed, identified through methods focusing on consistent, risk-adjusted returns, can certainly be solid options for your long-term equity allocation, provided you have that 7-year-plus horizon.
So maybe the final thought for you, the listener, is to consider which approach resonates more. Do you like the idea of some global diversification and potentially more stability in rough markets like Parag Parikh offers?
Or do you prefer a purely Indian focus that might capture more upside in strong domestic rallies, but potentially come with a bit more volatility, maybe like HDFC?
It really boils down to your own comfort level with risk and what you're trying to achieve with your investment, something to mull over.
Definitely. Doing that bit of self-reflection alongside understanding the fund's strategy is key.
You can catch further episodes of Your Average Indian Investor on YouTube or Spotify. Please like, share, and subscribe if you like our content.